Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is November 3rd, 2025, and we are taking a deep dive into the QQQ, the ETF that tracks the Nasdaq 100. We've seen some incredible volatility recently, with the market hitting all-time highs and then pulling back sharply, so there is a lot to discuss. First, let's cover the news that's been driving the market. Just last week, the market experienced a significant shock after concerns about rising AI investment costs sent shares of giants like Meta and Microsoft tumbling. This sentiment triggered the largest single-day percentage drop for the Nasdaq since early October. However, that bearishness was quickly challenged. The market then saw a strong bounce back to end the month, largely fueled by a positive shift in the AI narrative following strong earnings from Amazon and Apple. This highlights the intense push and pull in the market right now between the long-term potential of AI and the short-term costs of building it out. On the geopolitical front, there was some positive news from the APEC meeting, with the US and China agreeing to have fentanyl tariffs and resume certain trade activities, which is a generally bullish catalyst for the market. Economically, we're in a strange environment where Treasury yields are rising even amidst Federal Reserve rate cuts, putting pressure on bonds and potentially on growth stock valuations. So, the macro environment is complex. We have bullish trade news and strong earnings from some key players, but also headwinds from rising yields and sector-specific spending concerns. Now, let's see how this all translates to the charts, starting with the daily chart for QQQ, showing the price action over the past year and a half. The dominant feature is a powerful, long-term uptrend that began after a very volatile period this past spring. From a low of around $402 in early April, the QQQ has staged an incredible rally of over 58% to its recent highs. This strong upward momentum is the primary trend we need to respect. The market set a new all-time high just last week on October 29th, touching $637. This level now stands as the key resistance and the primary target for bulls. However, look at the last two daily candles for October. We see a sharp rejection from that high. The price dropped over 1.5% in 2 days, closing the month at $629. This pullback corresponds directly with that news about Meta and Microsoft's AI spending concerns, showing a clear link between market-moving news and the price action. To understand the foundation of this bull run, let's zoom in on the extreme volatility we saw back in April 2025. Here we can see the price broke down hard from the $480s, falling to a low of $402 on April 7th on massive volume. This looked like a classic capitulation event, where sellers were completely exhausted. What followed was an explosive reversal. On April 9th, the QQQ surged an incredible 12% in a single day on the highest volume we've seen all year. This marked a major turning point and established the $402 level as an extremely significant long-term support zone. Any major correction would likely look to this area as a worst-case scenario floor for the market. Now let's switch to the hourly chart to analyze the most recent price action from the last few weeks in more detail. Here we can see the steady climb throughout October leading up to that peak. The price action was orderly, with pullbacks being bought up quickly. The peak was hit around midday on October 29th, right before the negative news started to circulate widely. The sell-off that followed was fast and aggressive, slicing through several minor support levels. Price eventually found its footing around the $626 level on October 30th. This $626 area is now the most critical short-term support level to watch. A break below this level would signal that the pullback has more room to run. Drilling down even further to the 15-minute chart for the last trading day, October 31st, we can see the intraday battle. The day opened with a gap down, but buyers immediately stepped in, preventing a follow-through of the previous day's selling pressure. The price chopped around but generally grinded higher throughout the session, closing near the day's highs. This price action shows resilience and suggests that dip buyers were active, likely encouraged by the positive sentiment from Amazon and Apple. It formed a constructive base above that $626 support level we identified on the hourly chart. The key takeaway here is that despite the sharp scare, buyers were not ready to give up control just yet. So let's put it all together and recap the key levels and potential scenarios, bringing back the daily chart. First, let's clearly define our price levels. The ultimate resistance is the all-time high at $637. Immediate resistance is the current zone around $630. On the downside, our immediate support is the recent low of $626. Below that, the next significant support area is the psychological $600 level, which also aligns with the breakout point from late September. A more substantial support zone lies around $590, which was the peak in mid-September. Now for the outlook. The bullish case, which I believe has about a 65% probability, is that this was a healthy, news-driven pullback in a strong uptrend. The long-term momentum is up and dip buyers have shown their presence. If QQQ can decisively reclaim the $630 level on good volume, the path is clear to retest the $637 all-time high. A breakout above $637 would signal a continuation of the primary uptrend. The bearish case, with about a 35% probability, is that the recent high was a market top, and the concerns over AI costs and rising yields will lead to a deeper correction. The first warning sign for this scenario would be a break below the $626 support. If that level fails, a move down to the $600 to $590 support zone becomes highly likely. A break below $590 would be a major red flag and could signal a broader trend change. Things to watch for will be volume on the next move, any upcoming inflation data, and, of course, continued news flow from the big tech sector. Keep these key levels on your own charts. And finally, a brief disclaimer. This video is for educational and informational purposes only. It is not financial advice, and you should always conduct your own research and consult with a professional before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you in the next video.